Welcome, ADK and financial planning world community. Dan Davis coming to you the week of April 15th, 2024. Purpose of our discussion today primarily is around geopolitical risk and the moves that we've made this week. Secondarily, we'll talk a little bit about inflation in the bond market. So starting off, I would say that I'm not surprised that Iran attacked Israel. I'm also not surprised that Israel countered. I'm super surprised that the market hasn't freaked out over it. I would have thought that when this video is being filmed, which is on Friday, the counterattack occurred Thursday evening when I was having a drink and watching it. I really thought, wow, the markets are going to be really upset in the morning. And the futures were, and gold futures were up quite a bit, but in the end, the markets really didn't have that big of a day. I mean, certainly not a good day, but not anything I would have anticipated knowing the headlines. So some things that we had talked about in our last couple updates were that somewhere along the line, due to valuations as well as election, and if any geopolitical stuff sparked up, that we would start to reduce equity exposure, moving from a risk on to a risk neutral position. We did that this week. When Iran attacked last weekend, we then had an investment planning meeting over the weekend and pulled the levers on Monday, again on Wednesday, and then again on Friday. So in effect, we've moved from about approximately 10 to 15% equity exposure to different kinds of short-term bonds. None of that is new news. It's just that we've done it. You anticipated it. I said in past videos we do it sometime mid-April to late June, July. It's really hard to say. It was going to be driven by events, and so those events are here, so we've done that. Wouldn't have done this video if it wasn't for this, but I figured also with the inflation news that we've been talking about, I'll talk a little bit about that because that's of the outlook stuff we've talked about with returns, economics. None of that has changed with this. But the bond outlook's different relative to inflation. Inflation has been super stubborn. And we had said before that we thought that bonds would do somewhere between, 2 on the low side, 6 on the high side. I would say our view on bonds this year is more like 1 to 3 now because inflation's been stickier. What's causing that? We've talked a little bit about reshoring, patriotization of manufacturing away from China. That's going on, and it's very expensive. That's no new news. Something we discussed briefly is the difficulty in shipping because of the terrorist attacking shipping vehicles, that those ships have to then take a long way around, and that's adding a time and cost onto things. We've also talked about the unemployment being really stubbornly low, under 4%. It's been 50 years since we've seen the duration of this like we're seeing, which is good for our consumers. It's not good for wage inflation. But again, wage inflation is probably not bad for our consumers because we have more money to spend. But the more money you have, it does drive spending, and spending drives inflation. And then the last thing is just the amount of money that was stimulus-oriented that's taken a while for that government spending to actually happen. It's happening, and so all of those things combined together are causing inflation to be higher, which is holding the Fed back from lowering rates. We thought that they would lower rates somewhere 2-3 times. Now it's probably 1 or 2 in our view, and the markets don't like that, even though I think I think the Fed's doing a good job. So in summary, no real outlook change relative to stocks or economy. The risk reduction that we were anticipating has taken place because of the geopolitical hand that was played. Bond outlook is different. Nothing radical, at least not yet. We'll keep you posted. I appreciate the trust you place in us and your friendship over the last 36 years. Signing off from the St. Louis office, Dan Davis. Have a great day.